Navitas Semiconductor is currently trading at $22.32 per share, marking a significant intraday rise of 5.43% during this Friday session on May 15, 2026. While the broader indices are showing signs of exhaustion after a long week of trading, Navitas is carving out its own path, pushing toward its 52-week high of $23.82. The stock has seen a massive price range today, touching a low of $20.39 before finding strong support and surging back toward the $23 level. This volatility isn't just noise, it's the sound of a major fundamental shift. If you look at the volume, it's clear that institutional players are beginning to treat this as more than just a small cap component. The expectation among most casual traders was that the recent $125 million equity offering would tank the stock for weeks. Dilution is usually a heavy anchor, but the reality we are seeing on the tape is completely different. The market is effectively saying it doesn't care about the dilution as much as it cares about the massive partnership with Cyient Semiconductors in India and the rollout of the industry's first GaN power IC family for AI data centers. Investors are looking past the short-term share count increase and focusing on the fact that Navitas is now being designed into the literal power-hungry heart of the global AI infrastructure. This creates a massive curiosity loop for anyone watching the semiconductor space. Why is a company with an operating loss and a fresh dilution filing currently outperforming some of the largest names in the sector today? The answer lies in the architecture of the modern data center. Most people think of AI as just chips and software, but the bottleneck has shifted to power delivery. We are talking about CPUs and GPUs moving from modest power draws to requiring up to 175 watts for a single component. Standard silicon just can't handle that heat and efficiency requirement anymore. This is where the tension between expectation and reality becomes very profitable for those who are paying attention. The common ground belief is that Navitas is just a charger company for phones. The contrarian take, which the big money is starting to bet on, is that they are becoming the indispensable power regulator for the entire AI server rack. We are seeing heavy volume today as the stock attempts to stay above its 50-day moving average, a level it reclaimed with force earlier this spring. Institutional activity from firms like Vanguard and Millennium Management suggests that the smart money is positioning for a long-term transition. Comment below how many shares of Navitas Semiconductor you currently hold, or if you are looking to enter at these levels. When you look at the daily swings, the stock is currently riding a wave of momentum that began after the Q1 earnings beat. Even though the net loss was wider than some expected, the 18% sequential revenue growth was the metric that mattered. It signaled that the company's pivot to high-power gallium nitride and silicon carbide is actually working. Institutional buyers are looking at the 50% quarter-over-quarter growth in AI infrastructure revenue and realizing that the company is effectively replacing its old, lower-margin mobile business with high-value industrial contracts. This is a classic case of a company shedding its past to capture a much larger future market. In terms of sector momentum, the semiconductor group has been volatile, but Navitas is benefiting from a pick-and-shovel narrative. You don't have to guess which AI model will win when you're the one providing the power efficiency technology that all of them need to keep their data centers from melting down. The macroeconomic pressures of higher interest rates have weighed on many small caps, but the specific demand for energy-efficient power chips is proving to be somewhat rate-resistant because the ROI for data center operators is so high. Looking at the business model, Navitas is essentially a fabless semiconductor company that specializes in power electronics. Their TINA-SiC and GaN-Fast brands are the gold standard for high-efficiency power conversion. For years, they were known for making those tiny, high-wattage cubes that charge your laptop or smartphone. However, the current strategy, often referred to as Navitas 2.0, is about moving up the voltage ladder. We are seeing them enter the electric vehicle space, solar inverters, and most importantly, the 800-volt AI data center architectures. They recently unveiled a DC-DC platform that hits over 97% efficiency. In a world where data centers are consuming a double-digit percentage of the world's electricity, that 2 or 3% efficiency gain isn't just a technical spec. It's worth millions of dollars to a company like Microsoft or Amazon. Their recent partnership with NVIDIA for power delivery boards at the GTC event was the moment the market started to reevaluate their valuation. They are no longer competing with cheap consumer electronic parts. They are competing for a spot in the most expensive server racks on the planet. For those managing their own portfolios, this stock represents a high beta opportunity that requires a specific kind of stomach. If you are using investing sites or looking for investment help, you've likely seen that the volatility here is much higher than what you would find in something like an Apple stock or an NVIDIA stock. This is the kind of individual brokerage play that can define a year. If you're utilizing the SoFi trading platform or perhaps the Robinhood app, you've probably noticed that Navitas often moves in 5 or 10% clips in a single day. This is why many people prefer the diversified approach of Schwab Intelligent Portfolios or a Fidelity brokerage account where you can balance this kind of risk with more stable assets. Whether you're into self-investing or prefer a more guided online investing approach, understanding the technical indicators on NVTS is vital. The MACD turned positive just a few days ago, and despite the RSI briefly moving into overbought territory, the stock hasn't seen the typical sharp reversal. It's grinding higher, which often suggests a very strong underlying bid from buyers who are not looking to flip the stock for a quick 2% gain. When you compare Navitas to its peers like Power Integrations or Synaptics, you see a company that is still in its early growth phase. It's currently unprofitable, which is the main risk factor highlighted by traditional analysts. They aren't expected to hit break-even until their quarterly revenue reaches the high 30 million range. But for an online investment, you are buying the future growth, not the current trailing earnings. The revenue guidance for the next quarter is already pointing towards another 16% sequential increase. This is the storytelling psychology of the market.
The tension is between the current cash burn and the explosive growth of the target markets. If the reality of their data center adoption exceeds the current market expectations, the valuation could continue to expand even before they show a net profit on the bottom line. This is why you see such active trading on platforms like Interactive Brokers, where professional traders are looking to capture these volatility spikes. The future outlook for Navitas hinges on their ability to execute on these high-power contracts. There are several catalysts on the horizon, including the full-scale commercialization of their 5th-generation GenaSiC technology and further expansion into the Indian market through Cyient. The risks are real. Supply chain disruptions or a sudden slowdown in AI infrastructure spending could hit the stock hard. However, the opportunity lies in the fact that power density requirements are only going up. As CPUs move from 30 watts to 80 watts and beyond, the physics of power delivery demand the exact solutions Navitas provides. We are seeing a fundamental change in how energy is managed in high-performance computing. It's no longer about just getting power to the chip. It's about doing it in a way that allows for higher density and lower cooling costs. To summarize the central insights we've covered today, Navitas Semiconductor is currently at a crossroads where its financial transition is meeting a massive technological tailwind. The live price of $22.32 reflects a market that is increasingly confident in the company's Navitas 2.0 strategy. The expectations were for a slow recovery after a dilution event, but the reality is a stock that is aggressively attacking its 52-week highs. We've looked at the institutional activity, the technical breakouts, and the shift from consumer chargers to AI data center power systems. This stock isn't for the faint of heart, but it is one of the clearest plays on the physical infrastructure required to keep the AI trend running. The contrast between its past as a mobile component maker and its future as an AI power leader is exactly what is driving the current price action. Maintain your discipline, watch the volume at these high levels, and keep an eye on those sequential revenue growth numbers as they are the primary indicator of whether the bull case remains intact. The authority in this space belongs to those who understand that power is the ultimate constraint for the next decade of computing. In terms of individual brokerage decisions, this is a prime example where deep analysis beats surface-level news. Always ensure you are looking at the intraday movement to get the real story of what the big money is doing in the moment. Navitas is proving that even in a volatile market, specific technological leadership can create its own gravity. Keep monitoring the ticker as we head into the close of the week, as the price action here will likely set the tone for how the semiconductor sector opens on Monday. Authority in the market is earned by staying ahead of these shifts before they become common knowledge. Stay sharp and stay focused on the data.